believe in trying to function on or to focus on what's knowable and important. Now, interest rates are important, but we don't think they're knowable. And there are some things that are, this gets back to, sounding, who was it, Don Rumsfeld or something?
Known knowns and unknown unknowns and unknown unknowns.
The question is the box that says knowns and important, knowable and important, is there anything in that box? And can you tell what's in that box and what isn't in that box? And it's what I call knowing your circle of competence. And my circle of competence doesn't include the ability to predict interest rates a day from now or a year from now or 5 years from now. So I say, can I function without knowing that? It's the same way as predicting what business is going to do or the stock market is going to do. I can't do any of those things. But that doesn't mean that I can't do well investing over time.
I mean, but things have changed. They're different now because rates are so low. You have negative rates.
It's unbelievable.
And then you were talking about Edgar Lawrence Smith and his discovery about bonds versus retained earnings. And then I think you were saying that it makes, as far as central banks, it makes no sense to lend at 1.4% and then to have 2% inflation.
Well, it does make sense for you to buy bonds. Yeah. If somebody is telling you that they're going to try and destroy the unit in which the bond, the promise is included, they're going to try to destroy 2% of that a year.
Right.
And for you to now receive maybe 0.5% and pay taxes on it.
Right. I mean, so where do you think these low super rates are going to go and negative rates? I mean, what are the implications on?
Well, I would say that's the most important question in the world, and I don't know the answer. No, if we knew the answer, it wouldn't be the most important question.
Let me ask this way then. What has investing in equities changed given the interest rate environment? It makes equities look super cheap.
Yeah, no, it reduces the hurdle rate.
Right.
That's why they like to decrease it, is that it pushes asset values higher, because obviously if you promised to pay me something at 3% a year, that would have been a terrible instrument for me to own, almost any time in history. But today, if you're good for it, it's fabulous.
Right. I mean, did negative rates scare you, Warren?
They puzzle me, but they don't scare me.
You had a huge bubble in equity prices in Japan, and now you've had interest rates go to virtually nothing. You've had the passage of time. The country hasn't disappeared. People are going to work every day, and you've had the Nikkei, now at a third of what it sold for not that many years ago. It's an interesting phenomenon.
And huge fiscal stimulus in the whole period from the government.
Post-bubble periods, I think, depending on how big the bubble is, and how many were participating in it, but post-bubble periods, I think, can produce fallout that not everyone will be terribly good at predicting.
It's unbelievable what markets do over time. And since you brought up interest rates, in Japan, the 10-year bond is selling to yield 5/8 of 1%. 5/8 of 1%. I don't think there's anybody in our annual meeting of 20 years ago, certainly including Charlie and myself, who would have dreamt that a 10-year bond of a country, running a significant deficit would be selling at 5/8 of 1%. I mean, would you say so, Charlie?
Would I ever? But strange things happen.
Strange things happen.
But if that could happen in Japan, something much less horrible for the investing class could happen in the United States. It's not unthinkable. I mean, we could be in for a considerable period when the average intelligent, diversified investor in common stocks using fancy paid advisors just doesn't do very well.
But you can argue that if what we warned against and hope doesn't happen with derivatives should happen, it might create enormous opportunities for us in some arena. I mean, that we wouldn't be. That might very well turn out to be good for us if you get chaotic markets. You had a somewhat disorganized market in junk bonds last year because there were a lot of them created much faster than the funds available to absorb them were coming in. Now this year you have just the opposite situation. You have money pouring into the junk bond funds, $1 billion a week roughly, and that's changed the whole price situation. The world hasn't changed that much. It's just that the chaos has left the market for those instruments.
I probably could not have conceived of a world as recently as 10 years ago. I would not have conceived of a world where you would have full employment, 5% budget deficits, with actually the probability of those rising from that level, and at the same time have the long bond at 3%. I would have said that couldn't happen. And then people now, you have this modern monetary theory, which there's no question you should borrow, any country should borrow money in its own currency. I mean, that is not like it's some great discovery or something that's been announced, but
no, it can be overdone.
Yeah, and that's the point. I mean, that hasn't solved anything. Just to say, well, it's much safer to borrow money in your own currency, but the convergence of these factors would have seemed impossible to me, and generally, if I feel something is impossible, it's going to change over time. I don't know in what way, but I don't think we can continue to have these variables in this relationship. Now, if we can, then stocks are ridiculously cheap.
The one thing I will say, though, is this is a conversation I feel like we've had for at least 4 or 5 years.
Right.
Where you're watching and continuing to wait for these interest rates, the yields to rise. We're still sitting at 2.5% on the 10-year, which is shocking.
Yeah, and we're sitting with very, very little inflation with a Federal Reserve that put a target for 2% on it not that long ago. And it looks like nirvana. It looks like we found the promised land where we just essentially money doesn't cost anything, and you can print lots of money and have full employment and no inflation. And I would have thought that something would have happened before now. I don't know what would have happened, but I wouldn't think you could have these things at these levels, the long-term rates, inflation rates, budget deficits, and have that be a stable situation for a long period of time. And I still believe that, but so far I'm wrong.